Right now, the regulatory landscape, in our estimates, the regulatory changes will go into February next year before the two-session meeting, which means uncertainty to what more regulations will come and how those regulations will impact earnings is still highly uncertain. For us, we focus on sectors that we think will be supported by regulation instead. So we do still like renewable energy. We like this advanced manufacturing, just such as semiconductors. We also like still the 5G theme and some of the socially promoted sectors, such as sportswear. Those sectors are getting support rather than a crackdown on regulation. So we think investors should rotate into these sectors and avoid the number of sectors despite the fall that we have already seen.
When it comes to tech companies going through these regulations, do you steer clear away from them from now? How do you price in this risk when it comes to the tech sector?
What we are seeing is analysts across the street are still downgrading the earnings outlook to the tech companies in general. And in particular, it's very difficult for them to forecast the earnings outlook in the coming months as regulatory crackdown is still happening. So what we've been seeing overall is analysts revising lower the earnings outlook and have highlighted the risk and uncertainty to those earnings in the coming months. But however, if I look at the earnings downgrade that's happened so far, it's been quite modest. And to us, it seems that there could be further earnings downgrade into the coming months. And therefore, when we look at the valuation of tech companies, in general, they do look slightly cheaper. But if look at the Hang Seng Tech Index, the forward PE ratio is still at 27 times compared to renewable energy, which is at 23 times. To us, if earnings continue to be downgraded, it means there's very little upside in the near term until regulatory crackdown come to an end, and then we can then see how valuation have reflected reality in the coming years. So for now, we're still thinking we should avoid those sectors until we get clarity in the coming months.
Jack, everyone was hoping for better returns in the second half of Chinese equity markets, given the sort of lackluster performance we saw in the first half. Does that seem less likely now?
Well, we do think the market will rise in the fourth quarter and reach the year end and with the Hang Seng Index at about 27,000. So it's still somewhat a good high single-digit return from today. And that should be happening, but still, in order to outperform this mid-single-digit forecast, we will have to be in sectors that will avoid regulatory overhang and crackdown. So we have to be very selective. This is now 2021. This is not 2020 when you can close your eyes and buy any sector the market will rise. We have to be very specific on the sector selection and focus on themes that will avoid any regulatory risk in the portfolio.